Okay, guys, you are finally here. So let me show you about the courses I'm going to launch in the next year. So position swing trading, I just released it in October, so that's ready to go. That's the basic foundation of all my other courses. One thing about me is I have a different methodology of trading and investing. So if you have taken a course elsewhere, whether it's Online Trading Academy or whatever, I have one question to ask you. Are you making money? Is your tax return showing a positive number at the end of the year? If yes, which I don't think so, but if yes, um, my second question is it enough for you to become a professional, fully professional trader where you're drawing down money to actually live off of that gain? If so, then my channel is not for you. So, but if you're struggling as a trader and you've learned from different people and things are not working out for you, these courses are perfect for you. If you've never touched the market, you don't know nothing about stocks, it might be a little bit challenging, but you might want to keep my courses as like a Bible reference as you get better and better and the terminology starts to make sense, because there's a lot of information if you don't know nothing about stocks and you don't know nothing about finance. But I try to make my courses as simple as I could, because before I used to teach portfolio management and a lot of the people would have headaches, and it was very complex for them, especially if math is not your strong suit. So I try to make it as simple as I can and dumb it down in layman's terms. All you need is basic algebra and some common sense, and you can make it happen. Um, let's talk about social media. Well, first off, let me show you our office, our company. I'm shooting this from our office and not my mother's basement. Okay, if you have a chance, um, make an appointment with me. Come see us in Las Vegas. Um, there's our office. We plan to expand in LA as well, eventually once things pick up. But yeah, as I said in my prior video, there's a lot we're doing with Avalanche Partners. And if you take at least two of the courses, then you'll have an opportunity to buy discounted shares in my common stock, in my company's common stock. If you take all the courses, then you'll have opportunity to buy preferred stock at discounted prices. So I want to bring the right team of people into my company, as I have major plans in the future. Okay, so let's continue, because there's a lot of information to cover. So please tell your kids to get out of the room. Make sure your cell phone's off. Turn it off. Bring a calculator. Have something to write with. And if you miss something, make sure you rewind and rewatch it, because I'm a very meticulous person. When I'm watching a movie and my girlfriend starts talking, I pause it, I listen to her, and then I'm like, "Are you done?" Okay, and then I, resume. So I don't like it when I might miss something extremely important when she's talking. So it's very important you don't miss anything, because something I say now might be a part of a different course later on. Okay, so here we go. As far as social media, the most important social media channels that you should follow me on, Facebook should be priority, because on Facebook, um, I I allow you to see all of my trades, all of my investments, all my past investments. You can go and check them out. So if you can time them, you'll make money. But I try to post as much as I can. Okay, so I don't never have to charge you for that like other people do. So that's, go ahead and use it and follow me if you want. One thing is I cannot legally give advice, buy and sell recommendations, so don't ask me that. Okay, I'm just telling you what I'm doing. So if you want to copy what I'm doing, that's up to you. Also, do not hold me as a liability. Basically, if if let's say you lose money. Okay, so I don't post as I take a loss. So sometimes I might say something and then I might take a loss on it, and I might move on to another company. But you'll know my position sizes most of the time. YouTube channel, I'm rolling that out. YouTube, I'm going to be talking about different companies, basically financially dissecting them, just like Jim Cramer, pretty much. So YouTube is very important as well. And then Instagram, if you want to take a look at my personal life and see my goofy side, then go ahead and follow me on Instagram. And then I'm also on LinkedIn. I like to poke fun at the corporate cookie cutters who cannot talk back because they're worried about human resources taking an adverse action against them. I like to be free because I'm at a point in my life I can say whatever I want, and it's great. I don't have to worry about anything. And then Snapchat, I'm barely getting into Snapchat, but I still don't get the point. Besides the filters, I don't know. So Snapchat, once in a while I might use it. And then Twitter, instead of Twitter, I used to use StockTwits, stocktwits.com. If you're an active trader, you have to be on StockTwits because it has a lot of cool things like the mapping feature. It tells you where the hot sectors are, what's selling off, what's being bought. So I have an account on StockTwits. I have a lot of followers, a couple of hundred followers there. So there you go. I don't use WhatsApp, maybe once a year, and then Skype. I used to use it, not anymore as much. So there you have it. Facebook, YouTube, Instagram, LinkedIn. Okay, follow me there. And it's just Stocks Bootcamp. Let's make it simple. Besides, with the exception of LinkedIn, you have to put my full name, which is Edgar Ambertumian, and then you can follow me there. Okay, so the first course, Position Swing Value Trading course. I say value trading because, again, my courses are the first courses ever to include financial analysis. I don't trade junk. I don't just trade anything. And most day traders, they just look at a symbol and they just look at the technical patterns and they trade. I don't do that. I make sure that whatever I get in, it's a company that the financial institutions or the hedge funds are going to accumulate. If they don't accumulate, then of course I'm going to be sitting there holding a bag, basically an unrealized loss that I cannot recover from because I don't know how long it's going to take until the stock recovers. So I want to make sure that I'm in valued companies, preferably over 50 billion in market cap. Sometimes my speculative side, I'll go down as much as 10 billion, 5 billion. But the days where I'm trading junk and penny stocks, those days are over. I'll talk a little bit about that later. So spring of next year, I'm going to launch Momentum Day Trading and Scalping course. As I said, that course is a separate course on its own, has its own set of rules and regulations, and some of them are actually contrary to the position trading. So things like averaging down is a lot of times is useless in day trading. You have to cut your losses early, and taking losses is part of the game, as I mentioned. So that's going to be a very tough course to create because I'm just going to have a lot of different scenarios of me trading live and what I would do in certain situations. I think that's the best way to teach, instead of just me droning on an hour about just a technical analysis pattern. You're going to learn all the technical analysis patterns in Module 2 in this course. So as I said, there's a lot of manipulation, so day trading is not for everybody. And we'll get back to that. Options course, definitely you should take the options and the hedging course if you're going to take this course. Okay, if you take the position value trading course, you should definitely take the options and hedging because they're going to amplify your gains, and it's you're not going to reach triple-digit yearly gains if you don't take these courses. It's almost impossible to do it with just stocks, okay, on consistent basis. And then once you want to take your money management to the next level, Then you can take the portfolio management course, which I'm going to finish next year by fall of 2020. Okay. A little bit about my favorite professor, Ronald Sweet, in University of Texas at San Antonio, where I finished school. He was the only professor who had an impact on me, and it was one of the toughest classes I ever taken. Our final was to do a 30-page thesis on a company that we chose and thoroughly do a discount cash flow analysis and a financial analysis. So I barely got a B, but I used a lot of that information to write an article on Seeking Alpha that won an Editor's Choice Award and got over 200,000 views. So you should Google that article called An In-Depth Look at Chevron's Profitability, and my article should pop up, and you can follow me on Seeking Alpha also. This man was a genius, and the $40,000 in student loans that I accumulated finishing school was worth it just for that one class. And within the first 10 minutes on the first day, I'd say 20% of the class was whispering and already thinking of dropping the course after reading the syllabus because they were afraid and they wanted to take an easier class. So they were already looking to switch, and I was like, no, I want to learn. I want to stay in this class, and I'm glad I did. So when you come into this boot camp, I'm going to be strict because it's a boot camp. Okay. I know you don't see it, but there's a scar on there's a little scar on my chin, and this was because when I was in Armenia and I was talking during class, the teacher threw a set of keys and bust my chin open. Okay, because I was talking to a girl, I was trying to hit on a girl, and I'll never forget that day, and the education system back in the day in Armenia and Russia and Kazakhstan, where I went to school a little bit for a couple of years, it was way tougher than here. Whereas when I was graduating UTSA, we had an auditorium full of 300-400 people, and I'd say 70% of it was on Facebook and Instagram, not even paying attention to the professor. So I'm very strict in terms of teaching and also people showing me respect when I speak. And I think that you should be taking notes and making sure you don't miss any information. And of course, you're going to pay for this course, so it would be stupid for you to miss any type of information, right? But that strictness was ingrained in me when I carried this scar with me for the rest of my life. So when you come into my boot camp, you represent me after you graduate. And so when they say that, lawyers say when they go to law school, basically a law school takes their brain and reprograms it as to what's right and wrong. So they start looking at things differently. So that's what I'm going to do to you. There's a lot of information, and everything you've thought you knew about Wall Street and all the myths that you hear that stock market and trading is gambling and all this BS, most likely you got it from people that lost money in the markets. So as you know, most people lose money in the markets. The people who make money on a consistent basis are the fund managers. And even a lot of hedge funds, they go out of business when they take too much risk. So everything boils down to risk. And that's why this is the first course the first module I'm going to talk about primarily risk management. And risk is everything, because I don't consider myself a trader. I did when I was starting out. I was telling everybody I'm a day trader. But as I got older, I realized I'm a risk manager. I manage risk, and the profits take care of themselves, right? So again, my first course, okay, the position trading, that's, I say you crawl, you walk, you jog, you run, and then you sprint, right? So my swing trading course is the crawl, and then the day trading, you'll walk, and the options, you'll jog, And the hedging you'll run, and then once you get the portfolio management down, that's when you'll sprint. So, and that's how I envisioned these courses when I was creating them, as to slowly turn up the heat on you as you get better and better. So under this module, we can talk about technical and fundamental analysis, the risk-reward diagonal line, position trading versus day trading, Martingale strategy. We can talk about the animal farm, which is the bulls and the bears, the systematic versus unsystematic risks. We can understand the beta of how that works. Hardly any of the traders look at beta when they're trading, and that baffles me. Beta is everything to me. And you're going to see how beta defines correlation and volatility. We're going to look at market cap and the importance of that, the outstanding shares versus float. We're going to look at growth stocks versus dividend stocks. And then you're going to get a little intro of my value score that I created. So I have my own value score that I created with my own components that derives from financial analysis. And then I'm going to end the course with margin risk, which is if you're a swing trader, you hold stocks overnight, your margin risk should be utmost priority, because last thing you want to do is get a margin call. So I'm a very meticulous individual, and I calculate everything. I'm addicted to numbers. I've always been since I was a little kid. So let's say when people say you have a life expectancy of 80 years, that's not necessarily true. I actually calculated to be 62 years if you live a full life. Okay, so let's look at 80 years. You take 80 years, you multiply it by 365, and then you multiply it by 1440 minutes a day. That gives you 42 million minutes, right? So 42 million minutes is 80 years. But you have a lot of things that you got to do. You have to give a lot of your minutes to work. So let's say you have to work 50 years. So that's 6 million minutes right there. And the calculation is 480 minutes times 253 work days a year times 50 years. What is that? That's 6 million minutes just you spend on work. And then the commuting is another 759,000 minutes, let's say, if you spend an hour a day for 50 years. And then the chores, if you have, the more kids you have, the more chores you have. And I'm laughing because I don't have any kids and I don't plan to have any kids because time is very precious. So then that's, chores, I calculated for 80 years you can have chores. Hygiene, showering and all that, 876,000 minutes. And then so your true life minutes after you deduct all that is 32.5 million minutes. Now, how would you backtrack 32.5 million minutes, which is what's left of free time for you to enjoy? How many years is that? So you backtrack, you divide that by 1440 minutes a day, which is each day has 1440 minutes, and then you divide that by 365, and you get 62 years. So your true life is 62 years. That's if you don't get hit by a bus, so, and nothing tragic happens to you. So that's your full life, 62 years. So the key takeaway is don't have any kids if you want to have a lot of time to yourself, right? So for those of you who had kids, things are much tougher for you if you're not a millionaire, right? Have you heard of the expression time is money? Well, my whole life I thought of time as money, but it's actually the opposite. Money is time. Okay, so that's how I think. When people say I'm a millionaire, I'm thinking you're not a millionaire, you just don't have to work 15 years. If you're single and you don't have any kids and a lot of expenses, then $1 million is about 15 years of not doing anything in Los Angeles, let's say. Okay, if you move to Philippines, then yeah, you might be retired with $1 million. But let's say in American standards, you're not impressing me anymore when you say you're a millionaire. When you say you're a multimillionaire, that's a whole different deal. But a millionaire, can go away real quick, especially with the inflation, and the low wages. So $1 million is not what it used to be. Okay, back in 60s, $1 million was a lot, but not anymore. So from now on, when you hear people say time is money, no, money is time. Okay, don't go and buy a brand new Mercedes when you have a little bit more money, or as a real estate agent you closed a couple of deals. No, just think of that money. You take that money, you convert it into time. Okay, how many more years can I do nothing? So once you have $3 million, that means you don't have to do anything for the rest of your life. If you don't have any kids and you don't have a lot of expenses and you're going to live a frugal life. Okay, so it's all about relativity. So who are my courses for? Okay, my courses for, number one and foremost, as I said, a stock trader who's losing money by listening to Instagram gurus under age 30 with no consistent profitability. These guys show explosive gains of 4,000%, but for some reason can't repeat the process due to fear of becoming a billionaire. And since a lot of people don't understand basic math, if somebody says, I'm consistently profitable and I just made 4,000%, I'm like, if you could make 4,000% 3 times, you would become a billionaire. Do you understand that? None of these guys are billionaires. None of these guys are going to be billionaires in 3 to 5 years, and they're all going to disappear. I've seen so many people come and go in the last 15 years. So I'm going to show you something. I'm going to show you how to calculate on Excel. Okay, here. You open Excel. If somebody says, I turned $50,000 into a couple of millions, okay, in 45 days, okay? And all these guys claim like 1,000% up to like 10,000%. Like, you're ridiculous. Who are you lying? So anyway, look, you press the equal sign. Let me zoom in a little bit. Hold on one second. Sorry. Okay. So you go equal sign, you type FV, future value, tab, open parentheses. So I don't know, what's the rate you want to put? 4,000%, let's say. Okay, let's say this Generation Z Instagram guru said he made 4,000%. I always mess with the Gen Z. I don't know why I do. But I'm a millennial myself, guys. I'm 37 years old. I'm a millennial, so I can't talk too much crap about them. So 4,000%, and then the second one, you press comma right after comma, and then NPER is a number of periods, right? So let's say he's going to make 4,000% 3 times, which is in 3 years, once a year. So he's going to make 4,000% 3 times on $50,000. Okay, so we're going to put 3, we're going to put comma. For payments, PMT, you put 0. We're not doing payments. And then the present value of his money, you're going to do negative 50,000. Okay, and then the type, don't worry about it. It's end of the period or beginning of the period. We're going to say 0. Right? Don't worry about that. So look, he's going to make 4,000% on 50 G's 3 times in a row, compounded 3 times. He would have $3.4 billion. So none of these idiots are actually, oh, I shouldn't say idiots. None of these imposters are saying what they mean. Okay, so don't pay attention to them. So let's see. So now you know how to use Excel a little bit. And then my next group of people is baby boomers. Baby boomers, guys, they're retiring at an astronomical pace, and they need to retire. They need to be able to manage their money, right? So my courses are gonna help them call their financial advisor and say, I don't need you anymore because I finished Stocks Bootcamp. So, and you're gonna make so much more money than your financial advisor would. And hopefully, you finish all the classes and everything makes sense to you. And even if you're a millennial or Gen Z, you can take control of your own money. There's all kinds of apps from Robinhood to TD Ameritrade. You can be on your phone You don't have any more excuse that, oh yeah, I can't, I don't have the time for it. No, my courses are designed for people who have full-time jobs. You can do this. All you need is like 30 minutes to an hour a day, if that. I used to trade from my bathroom stall when I had a job. Do you understand that? So don't give me the BS of that you don't have time. So instead of suffering from a recession, guys, you can start short selling. You can buy option puts, and you can profit from a recession going forward. Okay, so that's the main reason why people should take my course. Number three, the chartered financial analyst. Let's talk about the CFAs who want to strengthen their portfolio management skills. My course is for you. Of course, you already know everything, but um, why do you need a company to hire you? Why can't you make money yourself in the markets if you finish this grueling 4-year course? Like, you get the designation and you still can't find a job, then I feel very sad for you. Okay, because you spent about $10,000 to get that CFA designation. And it's amazing to me how many people I talk to on LinkedIn as a CFA. CFA, you're like, you know everything about finance and you still can't find a job. Or worse, you can't even make money on a consistent basis in the markets. That's pathetic. And CFA, a lot of their stuff is now ethics. Besides the level 1 and some level 2, it's just they want you to know your stuff in terms of ethics and portfolio management. So again, some people, I don't want to talk about this, but it fascinates me how brainwashed I was in school, because up to a point where I finished it, I was still thinking that I'm just gonna go out there and move up the corporate ladder. Okay, and then when I started moving up the corporate ladder, I realized that it's all based on whether my manager or my superior is gonna like me or not. So if they do, or if I screw up a few times, I'm done. So, if they like me, then I'll move up. And then even if I move up, the company might get rid of me, as I got laid off so many times, and then find somebody cheaper. So basically, it boils down to two things. Either you are a workhorse for a company, or you own everything. You're the actual boss, you're the owner. So it took me a while to realize after I finished school that, holy crap, school education system just teaches you to be a follower. It teaches you to be a corporate slave. So unless you're a doctor or engineer and you love your job, that's different. But for the most part, most people are basically the slaves of shareholders. And who's the shareholder? Sometimes the actual workers themselves, because their 401ks are tied to those companies that they own. So you own yourself. You know what I mean? So anyway, we'll get back to that later. The last one is anyone who was born without $1 million, including myself. Okay, I came to this country as an immigrant. I didn't have nothing. So, whose parents constantly tried to teach them the value of a dollar while masking their own mistake of having a child without truly being able to afford one. Okay, so all of your parents, if they were not millionaires, at some point as you got older, they slowly turned up the heat on you. They taught you the value of the dollar. They told you to go rake the leaves outside or wash the car, this, that, because they were broke themselves. And if they were not broke, they didn't have enough for you to do nothing. Eventually, they wanted you to get a job and start contributing because they wanted to mask their own, not all of them, of course, but for the most part, at least my parents and a lot of the Armenian parents I know, they try to show up this aura of them being successful when they're in actuality working paycheck to paycheck. So a lot of it is BS, guys, okay? So even your parents were hypocrites and you are a hypocrite. And I'm a very straight shooter in a lot of ways where numbers don't lie, okay? So I grew up in such a poor environment where people would families would actually hide the best candy and the best refreshments and all this, and they would hold it for whenever they would have guests, and they would take it out when there was a special occasion. Okay, so people were poor at that level, but they were trying to act like they have something, because when the guests would come, they would want to show that they have money, but in actuality they were all broke. Okay, so when I grew up and I saw that, I was like, this is pathetic to me. I never want to be in that situation ever in my life. Again, people in America don't have that problem, but because the standard of living is much higher here. But a lot of third world countries, they still do that. Anyway, enough blabbering about stuff that don't matter. Let's get down to business. Guys, everything in life, including stocks, securities, there's a risk and reward line. Okay, this risk and reward line is diagonal. Okay, so you have the more risk you take in life or in stocks or in any securities, then the more you have to get compensated for it. Okay, my courses here, the first course is gonna focus on blue chip companies. Okay, and then they don't make as much as small caps, they don't make as much as emerging market speculative stocks, but the blue chips are much considered safe investments, right? So if you want to increase your yield on blue chip stocks, then you have to buy the options, right? If you buy the options on blue chip stocks, then you'll have the same yield than if you have taken it on a micro cap or a small cap stock. So why would you want to take a lot of risk on a company that hedge funds don't want to accumulate when you can find the same yield in a blue chip option? And that's all I'm trying to tell people, but nobody wants to listen. So, technical analysis works all the time except when it doesn't. When I read this in Tony Turner's book, I was like, so what's the point of doing it? Really, I mean, technical analysis is might as well just roll the dice. Sometimes it works, sometimes it doesn't. In this picture, you see technical analysis, the cup and handle, you see that cup and the handle. It failed. It failed miserably. But I'm sure a lot of people bet a lot of money upon that right part of the handle, thinking that it's going to go higher, which it didn't. It actually collapsed. So, Tony Turner, she's an educator, but I don't think she's a money manager. But there's a lot of good information in her book, Short-Term Profits Trading. Again, what she said, it resonated with me many, many years. Technical analysis works all the time, except when it doesn't. Now, day trading technical patterns fail way more often than swing trading patterns. Okay, so when you have a major trading desk like UBS or Citi, and they want to unload a large order, let's say 50 million shares of Apple in one day, they call these Iceberg Orders. They're not going to tell you that they're going to unload 50 million shares of Apple, because if they did, people would panic and the stock would tank, right? So they have to layer in the smaller parts, and they have to mask the quantity of that order. And this is the main reason why day trading is very speculative, the main reason why day trading is so risky. Okay, and this is when they say, oh, it's manipulated, market makers are manipulated. This is the reason. Because when large funds, they want to dump their shares, they have to cut them into smaller pieces so that you don't realize somebody's unloading a lot of shares. So their sheer power is so powerful that it's going to erase your technical analysis chart patterns like an Etch-a-Sketch, making day trades less successful than swing trades in terms of consistency. In college, I was Bloomberg Platform certified. In Bloomberg Platform, this is a snapshot of a Bloomberg Platform level 2 order, right? So you got the size column. See under size, it'll say, like 1, and then here you'll see a 5, and then here like a 6. I'm sorry, here it'll say like a 5 and a 10. So each of these, you have to add 2 more zeros. So let's say a 1 is 100 share transaction. So 5 is a 500 share transaction. So someone's waiting to sell, let's say, 500 shares at $439.10, and someone's waiting to sell at $439.22, and everybody just lines up, right? So these iceberg orders are layered. Maybe the 10 and the 5 and the 4 here could be the same fund, same company trying to unload their shares. So they'll layer it like this, and you won't know that a major sell-off is happening until it's too late. Some people realize it, and then they jump out and they cut their losses. But a lot of times the market makers will do it on purpose, where they manipulate and they'll take the trade against you because they see the volume and the order flow of all the orders that come in and out. So they know exactly how to bet against you. So the game is kind of rigged if you think about it. So moving on. So technical analysis added a lot of broker transaction and a lot of liquidity. So because of this, I look at it as it was the most successful garbage that was introduced to the poor by the wealthy on Wall Street. Because guys, Warren Buffett doesn't care about technical analysis. Jim Cramer, I mean, he talks about it, but he doesn't care. He cares about annual reports. Warren Buffett doesn't even care about quarterly reports. He just reads annual reports. He has a long-term horizon of 5-10 years, right? So he doesn't care what happens from one quarter to the next earnings. He doesn't care. Okay, so technical analysis allows traders to try to find the direction and profit between those time periods of 3 months. So they can try to get in and out, and they try to find patterns to try to profit from those patterns. So here's the best way I can prove to you that technical analysis is garbage. Okay, if I decided to sell 10% of Facebook in the shower this morning, hypothetically speaking, okay, I'm taking a shower, I'm like, you know what, I'm gonna sell most of my company today, or a good percentage of my company today. I haven't even told this to my wife, right? So how is your technical analysis pattern gonna show what I'm thinking, right? So if you're a trader, you might be in a, let's say double top, okay? You're at a double top, and a double top is a pattern where you're about to short sell. So you want the stock to fall. So you're in a double top pattern, you think the stock's gonna go down, okay? And here I come, and instead of selling my stake, I decided to buy another 5%. So I just erased your double top pattern because I changed my mind that second, and everything went the opposite way now. So what are you going to do as a day trader? You're going to cut your losses, and you better lose your ego fast and admit that you were wrong and take the opposite side of the trade. So as a day trader, you constantly have these, once in a while, you're going to step on these landmines, which is, they call them, market maker manipulations, right? So the point I'm driving at is technical analysis cannot forecast anything. It just merely tells you what the stock could do based on historical patterns, which have already occurred, okay? So based on volume and the historical patterns, you still can't accurately predict the future, because the stock market volume and the buys and the sell transactions is based on the big boys, the hedge funds and financial institutions, making these large orders, and they're the ones who move the markets. Anybody who knows the inside information, that's illegal. You cannot trade on inside information if you know something. So for those of you who are still confused what technical analysis is, what fundamental analysis, if this is the best analogy I can give you. Okay, so technical analysis, think of it like this. Let's say you stand outside of Burger King and you watch people go in and out, and then you calculate how long it took him to go in and out, and you count how many people went in, and then you plot all that data and you make assumptions whether Burger King is going to survive as a company or not. Okay, Whereas fundamental analysis, financial analysis, is going inside of the building and asking the manager how much did they spend on the beef and the cheese, and do they own the building or do they lease it? And then after analyzing every single detail by asking questions, including all debt and legal fees for sexual harassment claim after the manager groped one of the employees by the fryer. I had to make that joke. Then you make your decision seeing whether any income is left after all the expenses. So which one is more accurate, guys? You want to go inside and actually get the numbers, get the details? Meaning, do you want to do financial analysis and see how much debt the company has, what's their income, and calculate everything right there, black and white? Or do you have more accuracy with the technical analysis pattern? You just stand outside and you look at the customers go in and out, and you make assumptions whether Burger King is going to go bankrupt or not. How do you know if the people who went into the Burger King didn't go and use the bathroom and come out? Maybe they didn't buy anything. Do you understand? Do you catch my drift? This is the reason why technical analysis is full of assumptions. So, like Tony Turner said, it works all the time except when it doesn't. So a lot of times it's just 50-50 shot. Okay? So it kind of gives you an idea on a longer term. When you look at yearly trends and you look at longer term trends, it makes sense because, of course, the psychology of people, it works the same way. But you cannot use technical analysis to predict the future accurately. Look at what's happening in the last couple of weeks. Patterns are failing all the time, and now Trump's tweets move the markets. It creates volatility. The news is so uniform. If one news source reports a positive news, then everybody else just follows suit. And if one news outlet reports something negative, and then everybody has to jump on the bandwagon and report something negative, because it's all about ratings. So now news events are moving the markets, which have nothing to do with valuations. Are we going to have China deal? No, we're not going to have China deal. Are we going to do this or we're not going to? It's just, it has nothing to do with finance. So over the long term, when you're looking for consistency, valuation and financial analysis trumps everything. So look, when I see all these Facebook comments and all these people who think they know everything, so when they first start out as day traders, this is the chart that they think. Okay, they look at the yield that day trading is going to bring you. So they say, okay, day trading is going to make me 100% a year, whatever. So they're looking at the yield and they get excited. So they say, okay, I want to learn day trading. And then, swing trading makes less money, of course, and investing makes even less percentage gain each year, right? So new traders are often lured by higher percentage profits. But what the actuality is, do you know how the chart looks? This is how it looks. In actuality, in terms of consistency of profitable trades, day trading actually ranks the lowest. So if you multiply the consistency of your profitable trades and you multiply it to the gain, then the picture is going to actually show a completely opposite picture. Wait, that didn't make sense. So then, swing trading actually looks much better, and investing in terms of consistently being profitable is going to trump highest. And of course, because all these financial institutions, all the 401k plans, all these investments that you make, they have to deliver, they have to be consistently profitable, because these are professional money managers that have to make sure that you make money on a consistent basis. So the day trading, even though you're trying to make more gains, you're going to have this back and forth taking losses. So you subtract all your losses and then you take money to pay the bills, and there's nothing left at the bottom. So in terms of consistency of making day trades, you're definitely going to rank the lowest. So that's why I teach people to start off with swing trading, which is the foundation. You start off with swing trading, and then you use a small portion of your portfolio to day trade. And whatever profit you make from your swing trading, you can take that profit and use day trading, improve your day trading skill. So you're always playing with the house's money. Got it? So again, I'm not bashing day trading. I used to be a high frequency trader. But day trading is like running through a field full of mines. Okay, you will get lucky here and there with a lot of home run supernova trades, but repeatedly you'll be taking giant steps backwards. Okay, and time is money, right? Money is time. So, if you took a loss, then there goes a couple of days of your income, right? You take different bet sizes, right? So you take different sizes each trade that you do. So you might be on a roll, right? You made 6 consecutively profitable trades. You made $200 here, 500 here, 300 here, and your confidence is building up, building up, building up. And then you take one heavy trade, and then that's the one that's going to go against you. It's going to set you back a couple of weeks or even a month. So my value swing trading course will help you diffuse the landmines and then cross the field safely. So it's going to take you longer, which means you're going to make less money, but you'll get there in one piece without blowing up your account. And that's the whole idea of this course, is I want you to keep trading. Just like Jim Cramer says, I want you to stay in the game. The way you stay in the game is you take less risk until you get better. So from now on, when you hear somebody says, I'm a professional trader, blah, 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 you need to understand what a professional trader is. All these gurus out there, they have tons of monitors, just like this picture over here. Everybody has a ton of monitors, and they're trying to, when I was young, right, when I was in my early 20s, I would look at people have a ton of monitors and I would get fascinated. I'm like, oh, this guy is successful. It's actually the opposite. All these people are trying to show you that they're smart by having a bunch of monitors as their profile picture. But that's the number one way you can tell me that you don't know what the hell you're doing, okay? As a matter of fact, if you have more than 4 monitors, after a while you start to get a headache and your focus is not right. I'm usually on a couple of monitors and I'm focused on 1 or 2 stocks that I'm trading, right? If I'm a day trader, I'm focused. But if you're looking everywhere, you want to have eyes on every single stock, you're going to actually do way worse. So that's one few ways that I know that when people have a ton of monitors, I'm like, I don't know. That's kind of a red flag for me. So what is a professional trader? Your trading income equals your realized gains, you subtract your realized losses, you take out capital gains taxes based on your bracket of your income, you minus commissions, then you take out money to draw down to pay bills, and that's your trading income. So do you know how hard this is, guys? Do you know how hard it was for me to maintain a $25,000 account when my girlfriend, I lost 2 relationships over the fact that I was trying to be a professional trader. I couldn't take my girlfriend to a vacation and I was living a frugal life just so that my account wouldn't go below 25,000. Okay, so don't think professional trader definition is, it comes easy. It's not at all. So I can totally detect people's BS. My BS meter goes off the charts when people say I'm a professional trader. I'm like, no, you have a full-time job, you have a side income of some sort. Okay, so one question you want to ask yourself is, what is your monthly expenses? Okay, $2,000 a month, $4,000 a month, $6,000 a month. Are you living in San Francisco or Tucson, Arizona? How many kids do you have? All that is, matters on your disposable income, right? Your disposable income is everything. So if you think you can survive as a full-time trader without having stress, think again. Okay, you're constantly thinking of not taking a lot of risks so you won't lose a lot, so that you can take out $2,000 a month to pay your bills. It's not easy, okay? But if you want to move to Philippines and live a single life frugally with a $50,000 account and make 30% profit a year, and your monthly expenses, let's say $1,000, and you're making $15,000 a year, yeah, you can make it work. But in living in LA, It's, you know how hard it is? So be careful of those people who say that they're professional traders. Okay, so position trading, which is swing trading, versus day trading. Is it for you if you're just starting out? Okay, so for majority of you, you have full-time jobs, you're going in and out of meetings, you don't have time, you don't have the time to watch the market constantly, then position value trading is the perfect thing to start with. Okay, if you're a day trader, you have to be in front of the computer for a while, at least a couple hours at the first open of the market. There's volatile hours, let's say the lunchtime in New York, and then the last 30 minutes of the close. But the majority of the action for a day trader happens the first hour, okay? And then the algos will eat you alive, so you shouldn't trade between those hours. So day trading is for unique persons that can stomach more risk and have a stronger common sense, and they have the ability to control their fear and greed. Okay, because these are the two emotions that are going to kick into gear as you're trading, especially if you're taking heavy risks. When I was doing, $80,000 to $100,000 position in Facebook or Apple, one little tick, costs a couple of $100 and goes up $1,000, gain or loss. So sometimes the feeling was so, so strong, like my heartbeat would slow down. My fingers would be numb from me just like biting my fingernails. Just, okay, what's gonna happen? One little tick here and there, it's major moves. So if you cannot stomach a lot of risk, then day trading, it may not be for you. So also remember, since 2009, scalping is much harder than it used to be because of algos. If you haven't read the book Flash Boys by Michael Lewis, you definitely should read that before consider day trading. So realistically, maybe 5% of you will become professional full-time traders. They say 90% of the traders fail. It's more like 95% now since 2009. So when I started out, I was a high-frequency trader. I was a point-and-click high-frequency trader, which means I would scalp small pivot points on oversold and overbought conditions 40, 50 times a day. Okay, I will show you a separate video in my Lightspeed trading account. It was like 500 pages. So I would do a volume of $11, $12 million a year. Okay, and people thought I was crazy, but it was working. I was making $20, $30, $40 each time I would trade, but I would make 40, 50 trades a day. Okay, so not everybody used the same tactics that I did. Okay, most people, especially now, the way they trade is they'll make a few trades in the morning and that's it. They'll go heavy, they'll come out either a winner or a loser. Okay, but I used to trade all day. I would trade the entire day from beginning till the end. My eyes would be red and making 40, 50 trades a day. So my commissions were ridiculous. With Lightspeed trading, your commissions are pennies, but they would add up. But because I was doing volume, it was not a big deal. So again, I want to reiterate that my personal rule is to only day trade with profits that you made from swing trading. So aka playing with the house's money. This is the very rational and logical way to keep your yields consistent. Okay? So the main benefits of position trading is this. You don't have to cut your losses immediately, just like day trading. Averaging down is encouraged on the right companies. This is very important. On the right stocks, averaging down is encouraged. Hedging, whether it's with inverse relationship, securities, ETFs, options, hedging can minimize losses. For example, oil goes up, transportation goes down, right? Chevron goes up, FedEx goes down. Sometimes this perfect inverse relationship turns into semi-inverse relationship, just like gold and SPY, and you gotta be wary of that. But you can find hedging very lucrative in a lot of ways. So I have a whole separate course dedicated just for this. It's just so fascinating, some of the hedges that I've done before. There's delta neutral hedging option strategies that I used to execute, and I spent tens of thousands of dollars just on delta neutral strategies. So you're not susceptible to algo-based manipulation. You can capture dividends. You can get into a stock a day before the dividends are paid out and get out with dividends. There's class action lawsuit benefits. Each year I get a stack of class action lawsuit papers that I have to fill out, and sometimes they win the lawsuit and I get money from that. And then you consistently, like I said, you're consistently more profitable than day trading. You better be, because it makes sense, right? I will teach you how to recover your losses where you're constantly profitable, at least most of the time. There's going to be times where you take losses, of course, but for the most part, you're going to realize most of your losses. The shortfalls is that there's overnight risk. Okay, something happens, geopolitical issues, a tension between, let's say, Russia or North Korea or whatever, God forbid, terrorist attack or anything like that can destroy you, right? So my friend's uncle lost a lot of money, lost like $500,000 on 9/11. So he panicked and he sold and he took a loss. So anything can happen. But when you're a day trader, you wake up every morning, you're 100% cash, you have nothing to worry about. So you wake up the next day and everything is great. You start fresh. But you missed the gap ups, overnight gap ups as a day trader. So then the second shortfall is it has lower returns than day trading because you're waiting for your stock to recover its losses and so forth, right? Okay, so how does my Slingshot value swing trading methodology work? So forget about individual stocks like Chevron, Walmart. Let's think of the entire stock market, okay, SPY. So every major sell-off on SPY brings you closer to the next reversal that is due, right? Think of a slingshot. You stretch a slingshot. Okay, you stretch it more and more and more. The probabilities of it snapping increases, right? So the more it stretches, then the more powerful the next reversal is going to be. So if you're the entire stock market is selling off, it's like 1, 2, 3 days in a row that it's selling up, 3 days in a row that it's sold off. The fourth day, it's going to reverse, and the more it sells off, the more powerful that next reversal is going to come, and that's when you need to bet the heaviest. Okay, I just gave you the main secret recipe, guys. I mean, this is my main secret of my course. That's how I do. Position size is everything. So you bet heavy on the right companies, or if you don't want to do the right companies, the entire stock market, and you do statistical analysis and watch your position size, and you'll know exactly at what point you'll recover your losses. So if you average down with the correct position sizes 2 times, 4 times, and you hedge accordingly, then when the reversal comes, that powerful initial force will slingshot you to a break-even point much sooner on your unrealized losses. So having said that, we're going to look into Martingale Strategy. If you don't know about Martingale Strategy, you should definitely learn about this. It's very basic. If you ever get a chance to do this, you can do this while playing blackjack in Vegas. And if you use Martingale Strategy on blackjack, most likely the pit boss will come to you and say, "Get the fuck out of my freaking casino." They'll know exactly what you're doing. This is worse than counting cards. So Martingale says this. Martingale says, there's no way you're going to lose 10 times in a row. If you do, then you're the most unluckiest person in the world. But let's say you play a $5 blackjack, right? You lost one hand, $5. The second hand, you bet 5, okay? You lost again. So now you lost total of $10. So what's your third hand? How much do you have to bet on the third hand so you can recover all your losses? So you're going to bet $10, right? So you lost again. Now you lost total of $20. Now you're gonna double up, right? You bet another 20 bucks so you can recover the previous losses, right? So then you go, you go to 40, 40 goes to 80, 80 goes to 160. So you keep doubling up until when you win once, and then that just brings you to break even immediately. So the bad part is you're gonna keep losing money, and you better have the bankroll to keep betting, right? But once you win once, you immediately broke even. You broke even, and now some people do the opposite. Some people do anti-martingale strategy, where every time they win, they double up. If they win that, they push that even higher. So some people use a combination of martingale strategy and anti-martingale strategy. Okay, so if you want to play conservatively, then you do use a martingale strategy, which means you lose and then you double your position or quadruple or what have you to cover all of your previous losses if you win once. Okay, so instead of having first hand, second hand, third hand in the stock market, it's the first pivot point, second pivot point, third pivot point. So every time it has a nice little sell-off, and we have a major reversal with strong volume. That's considered, let's say, the second hand and third hand. Does that make sense? So now let's start with the animal farm. Okay, bulls and the bears. I'm sure you heard of it. So the bulls, aka longs. So going forward, I'm going to be saying longs. Okay, so if I say longs, that means I want the stock to go up. Okay, so bulls hit you with their horns, you fly up in the air, and that's why the name came, bulls in the paw. And then the bears, they hit you with their paws, they bring you down. Okay, so that's shorting. Short selling is bears. So the bulls, there is a bull on Wall Street. Why? Why is there a bull on Wall Street? Because the companies need to grow their earnings. So long term, companies should increase profits and the stock should go up, right? Technically. And notice my company logo is even a bull standing on a bear carcass. Okay, it's because even though I started off as a short seller, I'm still a short seller, but my high frequency days, I would short a lot of these companies that deserve to be short, right? So I would short small pivot points, and my nickname was Armenian Bear. Armenian Bear 69, that was my nickname. But as your portfolio grows, you're holding a certain percentage of your portfolio long term as an investment, because you also get tax break, right? The government forces you to hold your stocks long term over 1 year so you can get a better tax break. Versus if you sell something less than a year, so if you're a swing trader, day trader, then you got to pay capital gains tax. So the IRS and the government, it encourages you to hold stocks long term so that the company has room to breathe. The company has time to generate more profits for you. So I'd say 20-30% of daily volume is retail traders buying and selling. But the major moves up, the gap ups, happen when large pension funds, financial institutions, they bring real money into the table and they buy long term, right? And then the shorts are the bears. So again, when you hear the word shorts, short sellers going forward, that's the investors who want the stock to go down. So remember, the bears, they hit you with their paws, they bring you down. So the bear wants the stock to go down. Now, every professional trader would rather be a bear for two reasons, okay? And the mainstream, they don't want people to know this, but this is intuitive for a lot of people, and this is the reason why most active traders, they short sell, because one, fear sets in faster than greed, right? If you yell fire in a crowded room, everyone's gonna panic, right? So when panic hits, the stock drops like that. So you can make 5-10% like this, and then it's gonna take days and weeks for it to recover 5-10%. But here's the second part. The second part is when a stock drops 50%, it needs to rise 100% to get back to the same level to break even, right? So look at that. If $8 goes down to $4, that's a 50% drop. But for $4 to go back up to $8, that's a 100% gain. So not only it has to go up twice as much to get to the same level, but it's going to take forever because greed comes slow. Slow. Nobody wants to step up. When Ulta Cosmetics sold off recently after the earnings, it was flatlining for so many days. Then slowly investors started coming up, and then once you see other investors get greedy and you're like, then that's when you jump on the bandwagon. And that's the human psychology. If you look at a restaurant, if you see a restaurant has 1 or 2 people in there, you're like, screw this place. But if you see people outside line out the door, people are waiting an hour to get in, you're like, oh, I don't mind waiting an hour. They must be good. That's when it's the same concept, guys. Either nobody cares about you or everybody wants you, right? That's how it is. So one tip, and in the courses, you're going to have these tips, you're going to have rules. You have to remember all of this because it's going to be on the exam. So one tip is there's always a list of stocks that are not shortable due to their lack of liquidity. Or if, let's say, a new IPO came out, they don't let it be shorted for a little bit. They want to let the IPO breathe before short sellers attack the company. Okay, so sometimes IPOs are not shortable, and then based on liquidity and market size or a specific reason, you might not be able to short sell. Okay, so that's why I keep a couple of accounts open, because companies like SureTrader, which I'll get to that. By the way, it's in my broker review. You should watch my broker review video. So some brokers, they have a larger short selling list, and that's why a lot of day traders gravitate to those brokers. But those brokers have their own shortcomings, and if you should watch my broker review video for me to give you the most updated list of what I think of each broker. Now, in the indices, when you watch CNBC, you're going to listen to Dow Jones, NASDAQ, and S&P 500. These are the top 3. Then there's Russell 2000, Wilshire, and so forth. But the main 3 you're going to hear is Dow Jones, S&P 500, and NASDAQ. And that's all you're going to hear, okay, when you turn on TV. So, few very important things you need to learn about what each index does. Okay, so the Dow Jones is the largest, 30 of the largest companies in US. Okay, they employ about 5% of the US population with a cumulative market cap of $6.5 trillion. So one very important part, you need to learn this, is in Dow Jones, stocks that have a higher share price are given greater weight in the index. Okay, but this is not a great representation of the health of the US economy because it's only 30 companies. Okay, so if you look at a high price stock like Boeing, at this time of I wrote this, it was $354 a share. McDonald's was $205 a share. They have more impact on the final calculated value of Dow because their share price is high. So 354 is high, 205 is high. Okay, so the price counts. The higher the price, that's what counts here. So the calculation is, if you care to know, it's sum of the price of one share of stock for all of the components, all 30 of them, divided by the divisor. And then they calculate the divisor. The divisor right now is 0.14. Okay, so you take the sum of average of the 30 company prices, and then you divide it by the Dow divisor, which is 0.14. And that's how the Dow Jones is calculated. That's all you got to know. S&P 500, now look at this. S&P 500 has 500 large US companies. Not the largest, just 500 large US companies with a total value of roughly 25 trillion. Now, stocks like Facebook and Honeywell, 496 billion market cap, 125 billion market cap, have more weight on the index. Now, S&P 500 is a market cap weighted index. So S&P 500 gives more weight to the companies that have a larger size. Not a larger stock price like Dow, but the ones that have larger size. And the market cap, which is aka size, it changes every day. Just like the price changes every day. But this is why I like S&P 500, and I trade mostly S&P 500 versus DIA, which is Dow Jones, is because I like the fact that it puts weight on the size of the company, not the price. I can care less about the price, to be honest. But, newcomers, they think, oh, Amazon is $1,800 a share. That means it's expensive. Stock price has nothing to do with whether a company is expensive or cheap. That's a whole different question you're asking. Okay, so the market cap is equals outstanding shares times stock price. Stock price changes every day. Outstanding shares stays constant. Okay, so the market cap is going to change because the stock price is going to change. But the outstanding shares of how many pieces that one company is divided into, that's going to stay constant. Okay, so don't confuse outstanding shares with float or enterprise value, which we're going to discuss later. So most investors, including myself, we see S&P 500 as a better representation of U.S. economy due to its diverse broad of sectors and industries, right, versus Dow's 30, because 500 companies, that's more companies in different sectors. So it gives me a more accurate picture of the U.S. economy than Dow, which is only 30 companies. Make sense? I had a friend who would say, make sense. After everything he would say make sense. And I think I learned it from him. And I can't get it out now. So the last one is NASDAQ. So NASDAQ stands for National Association of Securities Dealers Automated Quotations. This was created back in 70s as an index of more than 3,000 stocks listed that includes the world's technology and biotech giants such as Apple. I'm sorry, not 70s, 90s, I think. That's a good question. I need to look it up. So it houses mostly technology stocks, okay? From Apple, Google, Microsoft, Oracle, Amazon, a bunch of others. So one thing you should know about NASDAQ is if a stock has 4 letters, then they belong in NASDAQ. Any stock you can think of has 4 letters, it belongs in NASDAQ. So when you see NASDAQ composite, the average move down, then most likely your stock's going to get affected, because if your stock is housed under NASDAQ, then it's going to affect. And again, with all the 3 indexes, if you have a stock that's 3 letters and it's under NYSE, then, if something happens to S&P 500 or the Dow, then your stock is going to, if your stock is under Dow, then it's going to get affected. Okay, so again, keep in mind that the market cap weighted stocks is under S&P 500 and the price-based importance is under Dow. Okay, so that's all you got to know about this. And NASDAQ was indexed in a global electronic marketplace. That's the only index that it's also electronic marketplace and an index. Okay, and this was the world's first electronic exchange. It operates in 25 markets. It has one clearinghouse and has 5 central security depositories in US and Europe. Okay, so who are the key market players? The key market players are financial institutions, pension funds, insurance companies, hedge funds, proprietary trading firms, sovereign wealth funds, and retail traders, which on some stocks it composes like 30-40% of daily average volume, and it's increasing. Back in the day, nobody cared about day trading, but with the technological advancement and the internet, lower broker commissions, and now all these brokers are now making their commissions free. Everybody is getting into the stock market. So right now we're having this crazy boom and crazy momentum of new people getting into the markets, which is amazing. Okay, now one very important thing that I want to get across is you're not a trader, you're a risk manager, okay? Newcomers, novices care about how much money can I make. When you become a professional, you care about what's the worst I can lose, okay? So every day when I go to sleep, I think in my head, okay, if tomorrow I wake up and SPY drops 3%, what's the loss I'm going to have? What's the unrealized loss I'm going to have based on the positions that I have open? Okay, so I get used to the norm. Okay, I get used to the norm. Let's say $2,000-3,000 move on the overnight risk is fine, right? But a large hedge fund, millions of dollars of daily volatility is the norm for them. It's crazy. So it's all relative. You have to get used to the companies you're trading, and your job is to manage risk. Okay? Your job is to manage risk. That's it. You always have to know the maximum loss and the worst case scenario of every trade you make before actuality occurs. Period. You manage your losses and your profits will take care of themselves. I promise you. It's a great feeling when you have an unrealized gain and you're just watching it get higher and higher. And then you set a trailing stop. You're like, okay, I'm good to go. I can cash out. And the next question is, when should I sell? Now that's a great question to have when you have an unrealized gain that's just sitting there and you don't care about cashing out. Okay? As a day trader, all you care about is cashing out, cashing out, cashing out. But when you have a portfolio, you're sitting on this large gain and you're like, all right, maybe it's time now. I can take a little bit of a profit. So again, you manage your risk, you manage your losses, and that's all you got to do. That's it. So again, this concept drastically differs from swing trading to day trading. In swing trading, you can recoup your losses by hedging and averaging down your cost basis. In day trading, oftentimes averaging down could be disastrous. So taking an immediate loss is usually the norm. Alright guys, I'm going to stop this video because my voice is getting coarse, so I'm going to take a quick break. Guys, here we go. Moving forward. So, there's two types of risks, okay? Systematic versus unsystematic. Systematic risk, it's also called undiversifiable risk, or also called market risk. So this is the entire market risk that is impossible to avoid. For example, Trump's tweets. Okay, if Trump tweets something, now it moves the markets. So immediately, this China trade deal thing can spook the markets, including economic indicators. If let's say the unemployment rate numbers or the PMI or initial claims, manufacturing data. So all of this poses systematic risk. So for you to be able to hedge against systematic risk, the way I do it is I buy option puts, or I'll buy fear indices like TWIX and UVXY. Okay, so systematic risk is overall market risk. And then unsystematic risk is a company-specific risk. Okay, so company-specific risk, which could be reduced through diversification. So let's say you're looking at Chipotle and the dairy costs are impacting Chipotle's numbers, and or higher fuel prices are affecting FedEx, and or let's say you hold a Microsoft stock and it's losing, and you want to diversify into another company, so you buy Apple to minimize your tech industry risk. But if you want to minimize your sector risk, then you might want to buy Starbucks, because Starbucks is totally in the restaurant sector, and then Microsoft and Apple are under the technology sector. So you can diversify yourself against unsystematic risk under the umbrella of, let's say, technology having different industries, or you can do diversification of outside of that sector and get into other companies like Starbucks or McDonald's, whatever. So in this course, we're not going to worry about unsystematic risk because we're not going to have a couple of stocks open at the same time. Okay, so this is going to, unsystematic risk, we're going to talk more about that in the portfolio management course. So on this course, we're just focusing on systematic risk, which is the entire market risk. You're going to buy one company, okay, average down on that one company. If it loses, you're going to average down. You're going to basically realize, you're going to recover your losses. You're going to hedge that company, and you're going to sell that one company. You're not going to have multiple asset classes open at the same time. As I said before, when you have a couple of stocks open at the same time overnight, you're entering the portfolio management. So it has a lot of different set of rules, and there's a lot you have to learn to do portfolio management, because if one company makes money and then you have your second company loses money, well, that just reduced your overall gain, right? So you're focusing on systematic risk affecting your one company that you're in, or whether it's an ETF, exchange traded fund, so it's a single security. So if stuff like Chinese tariffs, recession fears, natural disasters, war, terrorist attack, flash crash, any of that happens, you know what to do, which is either buy protective option puts or buy fear indices. So how do you measure systematic risk? Beta. Beta, beta, beta. This is the bread and butter of risk, and hardly any of the traders look at beta, even the swing traders. So we're going to do a lot of work on beta, and it's going to open up new doors for you, because there's a lot you don't know if you don't know beta. So beta is a measure of systematic risk. What's systematic risk? Market risk. Is a measure of market risk which tells you the correlation of a stock versus S&P 500 benchmark and volatility. So beta of 1 means it's perfectly correlated to SPY, which is S&P 500. Okay? So if a stock has less than 1 beta, it has a low correlation to SPY. So it also could have low to high volatility. Okay, just because it's less than 1, it doesn't mean it has low volatility. It can also have high volatility even though it's less than 1. Okay, this is something that a lot of people get it confused. Okay, so if a beta is more than 1, then it has a high correlation to SPY and high volatility. Okay, now if beta is negative number, like negative 1.3, for example, then it's inversely correlated to SPY, which is a prime candidate for a hedge, and we're going to learn hedging in my hedging course, much more in depth. So a key takeaway, again, is low beta does not necessarily mean low volatility. You must know every stock's beta you are trading if you want to survive this bootcamp. Got it? So, classwork number 1, do it now. I'm going to put you to work. You're going to find beta for these stocks, and I dumbed it down for you. So number 1, you go to Zacks.com. Number 2, you search ticker box. You type the stock symbol, and then you search, and then you'll see number 3, the beta in the quote overview. You can also check this number on yahoo.com/finance under the statistics tab. Or you can also look at it at finviz.com. Or you can look at it on your broker platform. Sometimes the beta number might be different, but it'll give you an idea when you check different sources. Okay? So, fine, let's go ahead and do one. Okay, we're going to look at Walmart. Right now I have Walmart as beta 0.43, but let's see what happens if I check now to see if it's 0.43 or has it changed. So I'm going to look at Yahoo, okay? And Yahoo has the most commercials on the planet, I swear. By the time stuff opens, it takes forever. Yahoo was a great company before. What happened, man? After Alibaba bought them out, but a huge chunk of it turned to crap. So, not waste management. I'm looking for Walmart. Okay. So you go to statistics. Beta right here. Beta 0.65. When I wrote this, the beta was 0.43. Let's look at Zacks. I want to see what Zacks says. Excuse me. So Zacks is showing 0.4. Why is that? Well, you got to be careful because if you recall, in Yahoo, it's showing the 3-year beta. Okay? So the Yahoo number had a 3Y next to it, so be careful. Okay? You want to make sure you're comparing the right data. So Yahoo is calculating the 3-year average of beta, whereas Zacks is more important. Okay? So if you want to get the most recent data, look at Zacks. And I'm going to check FinViz right now too, and you can do the rest yourselves. Jesus Christ, it's so slow. Oh my God, let's go. I'm a millennial, man. I don't have time. Okay, see this? 3Y, 3-year monthly. Right here, you'll see all the abbreviation guide right here. Okay, so let's look at FinViz. FinViz is a great site. I really like FinViz. Because it gives you all the snapshot of all the data, financial analysis, and technicals right there in front of you. Boom. Where is beta? Of course, commercials. Am I going blind? I know they have beta here. Here, 0.43. So, yeah. So see, it differs, 0.4 versus 0.43 and so forth. But let's say with, it's 0.43 right now, right? So Walmart has a beta of 0.43. What does that mean? So this means it's 57% less correlated than SPY. So if SPY has a beta of 1, you take 1.0, you subtract 0.43, and you get 0.57, right? So 0.57, that just means it's 57% less correlated than SPY. Now you guys go ahead and do Tesla, Denny's, Kronos, US Steel, and Agnico Eagle Mines, and tell me if it's different. Well, you cannot tell me, you cannot talk back, but tell me, not tell me, but figure out for yourself how different this number is and do the calculations. So if it's 0.26 that I had for Tesla, it's 74% less correlated, okay? Again, beta 0.13, it's 87% less. 1.0 minus 0.13 would give you 0.87, which is 87% less correlated. So let's say you did all that, right? So what does beta tell us? So beta tells you this. It tells you that If you're holding Walmart and SPY falls 1%, that means you should lose roughly 0.43%. Get it? So it gives you an idea of how much you're going to lose. So this is the foundation of risk. I don't understand how people don't look at beta. Same with Tesla. If Tesla is beta 0.26, this is why I like to trade Tesla, because the entire market can sell off and Tesla's going up. Like today was a prime example. I love it. I love Tesla. So in a restaurant, a lot of the restaurants, they do their own thing. They don't even care about the overall market unless it's a really crazy sell-off happening. Then yes, you're going to have a downside. But for the most part, if you want to protect yourself, you jump into companies that have a low beta versus SPY. They have a low correlation, and you'll be fine, right? Now look, Denny's is 0.13. So that means if SPY falls 1%, you should expect to lose 0.13%, which is nothing. On the other hand, Kronos, which is a crazy beta and it keeps moving a lot, Kronos Group, lately marijuana companies are all under huge volatility in that whole sector. You can lose 3.43%. Okay? Now here's the thing. And on Kronos's instance, so 243% more volatile and highly correlated. Remember, when it's more than 1, it means it's also highly volatile. Okay, so it's 200. If it's 343, so it's 243% more volatile and highly correlated, because remember, SPY equals 1, right? So if it's 3.43, that means you subtract the 1, you have still 243% left. And US Steel, another one, is very volatile, guys, and it's highly correlated. So if the entire SPY falls 1%, then if you're holding US Steel, then the beta of 2.8 will tell you that you're going to lose close to 2.8%. So it's not only it's highly correlated, but it's also highly volatile. Now, the outlier, the last one, is when you have companies that have a negative beta. When a company has negative beta, that's automatically a candidate for a hedge, okay? Because it lets you protect yourself against downside risk. So this is a gold company, Agnico Eagle Mines. And I use gold as a hedge a lot of times, even though it's not a perfect hedge, but most of the time gold companies, or especially GLD ETF, is a great hedge. So if let's say SPY falls 1%, if you're holding Agnico Eagle Mines, then you should gain 0.3%, not lose. Get it? So you are protected. Now you can use gold stocks like this as insurance because it has an inverse correlation to SPY. Okay, so hopefully that didn't confuse you about the low volatility and high volatility. Okay, it's a little confusing. Just know that when it's over 1, then it's also highly volatile and highly correlated to SPY. Whereas if it's less than 1, it can be either low volatility or high volatility. But it's low correlation. Okay. So next thing is market cap risk. Market cap risk. I created that terminology in a way because for me size matters. Okay, and I put a little rooster out there. Just a little joke. I'm sure you guys can get that. Market cap, okay, is the aggregated market value of a company in a dollar amount. Just like I said before, market cap equals outstanding shares multiplied by stock price. Okay, so again, market cap constantly changes every day because the stock price changes. The outstanding shares stays the same. Stock prices changes because stock price changes every day. The size of a company changes every day. So stock company size is extremely important. And for me, I do have market cap risk because if there's a recession, I want to stay in larger cap companies, larger size companies, because they're going to survive better. They've survived many recessions before. Chevron is one of my favorite companies because throughout recessions, they actually maintained their dividends. Okay, so they're very strong. So it's intuitive companies like Amazon are going to perform better than companies like GameStop, which is slowly dying. It's a small cap company, but Amazon is killing all the retailers, right? So you want to hold the large companies because if they get cheaper, number one, they're going to get accumulated. Number two, they're going to survive recessions much better. So why would you want to go and pick risky companies unless you're shorting them? So that's a whole different ball game. So even if Amazon's sales slow down, it can tap into its cash hoard and survive the stormy seas, while GameStop drains its short-term cash and falls into a bankruptcy. Again, a main tip I can give you is smaller cap companies always pose a larger risk during a sell-off. Their panic sells can trigger losses way beyond calculated betas. That's very interesting to know, is because when you have a small cap company, don't rely too much on their betas. Those betas, take it with a grain of salt because they can move a lot. Especially during a major sell-off, the small cap company betas go insane. Okay, they deviate too much. Whereas the larger cap company betas, for the most part, they're fairly stable. Now, we keep talking about outstanding shares. For those of you who don't know what that is, we're going to discuss outstanding shares versus float. Okay, so the outstanding shares is the total number of shares issued and actively held by shareholders. So if you have a company, how many partners do you have? Look at it that way. Okay, so when a company goes public, it has millions of partners because now everybody, the entire public, can buy the company. Whereas if you have a private company such as myself, I have an Avalanche Partners, it's a smaller group, right? We have 21 investors right now. So when I take company public, that was the goal with Avalanche Partners, is to take it public. We'll see. Eventually we may do that. We don't know. But if I take it public, I'm going to have millions of people who buy the stock, right? So outstanding shares tells you how many shareholders you have. How many shares, it doesn't say how many shareholders it has. It says how many shares are out there that are bought. One investor might buy millions of shares. So you can go under Yahoo and see the largest shareholders, which is usually hedge funds and so forth, and what is the percentage of the entire company that they're holding. So, and then the float is you just subtract the restricted shares, such as insider held or stock options for executives and so forth. So the float is always going to be smaller than outstanding shares. And the difference is the percentage held by the insiders, right? So in order to gauge market cap risk, you should always know the outstanding shares and the float of the companies you're buying. Okay? The key takeaway is if a company has a lower float, if it has a smaller float, then it has less investors, and it's a higher volatility risk, right? So smaller float translates into a higher volatility risk because few investors can actually move the company. You're looking at what's happening with Bitcoin right now. Is Bitcoin, has a couple of large investors. I don't know, what's the market cap? It's like 20 billion or so right now, which is not, is it 20 billion or 5 billion? Something like that. Few large players can move Bitcoin, you know what I mean? And that's risk. When you have a huge diversification of your investors, you have large investor base, then if few investors sell, your companies can still move forward without them. But if you have a few investors and then they take their money and run, what are you going to do? Your stock will sell off hard and it'll spook the rest of the investors. So a lower float is always going to translate to higher risk, so higher volatility risk. So I want you to go ahead and compare Apple and Berkshire Hathaway's outstanding shares versus float difference. Okay, let's go ahead and do that right now. So let's look at Apple. Are you kidding me? What's going on right now? Okay. So Apple's market cap is 1 trillion right now, right? Shares outstanding, $4.52 billion. Okay, that's how many shares outstanding it is. Okay, it's $1 trillion company, guys. You take the 4.52 billion, you multiply it by 227.03, which is today's stock price, and you'll get the market cap, 1 trillion. Get it? And you want to backtrack, you take 1 trillion, you divide it to 227, you'll get the outstanding shares. Now, let's look at Berkshire Hathaway, which is Warren Buffett's company. There's type A and type B. We're going to look at type A. Market cap, 506 billion. But look at shares outstanding, 709,000. 709,000, guys. That's how many shares it has. You take 709,000, you multiply it by today's share price, which is exactly 310,000, and you will get $500 million market cap. Okay. Moving forward. So, second class work. Do it now, right now. You're going to look at market cap, you're going to look at the outstanding shares, you're going to look at the float for the following stocks. I did Starbucks for you, so you can go ahead and look at the Jack in the Box, Cracker Barrel, and Wendy's. On the left, I tell you, like I just did, go to yahoo.com/finance, or you can look at your broker platform. And then on Yahoo, you can click on the statistics tab and find that information. Again, every broker platform will have this. It's whatever you're used to. So I'm going to assume you did that. Anyway, going forward, now we got dividend stocks versus growth stocks. This is very important, okay? Dividend stocks, these are companies that pay dividends each quarter. These stocks don't grow as fast since they return dividends to shareholders, right? So if you're a company that pays dividends, then you don't have that money to put it back into the company, right? So these companies are not going to grow as fast. Whereas growth stocks, for example, like Facebook, Berkshire Hathaway, they don't pay anything to their shareholders. They take whatever money they have and they replow it back into their company. So, of course, if they do that, then their companies grow faster. So, if you look at stock symbol IRM, which is Iron Mountain, or Annaly Capital, NLY, you'll see that these companies are dividend-paying companies, number one, and they recover at some point. They have a base because when a dividend-paying stock falls, okay, its dividend yield rises. Okay, so if it's a really good company and it pays dividends, at some point it's going to hit a bottom. because the yield, dividend yield rises so much when everybody just jumps on it. A perfect example, it's LVS, Las Vegas Sands, one of my favorite companies, casino companies to trade. It has a hard time going below 50. Okay, every time it goes to that area, dividend yield shoots up, and it has a lot of accumulation for big funds. Okay, this is Las Vegas Sands. I'm gonna look at a longer chart. This is a 2-year chart. Look at that. Every time it goes below 50, it gets nice accumulation, and it's been bouncing off and at a nice support between $50 to $52. So again, remember that about dividend stocks is when stock, excuse me, my throat. I keep losing my voice every time I talk for a long time. So a huge powerful advantage is when a dividend stock company sells off. At some point, if they can maintain those same dividends, because remember that sometimes when a company stock falls a lot, the board might decide to suspend dividends or decrease dividends. For example, Bank of America, at some point, they suspended dividends when Moynihan took over. So if a company is doing fine, it has a nice sell-off, but fundamentally company is still strong and they're going to maintain their dividends, then believe the fact that the stock is going to find a bottom at some point, because the dividend yield is going to rise and people want to accumulate as many shares as they can so they can capture that dividend. So as a swing trader, you should look at these scenarios because that creates a very good risk-reward opportunity for you, because it gives you confidence that a stock has a bottom at that point. So another classwork for you, you should do it right now. Find the dividend yield, the rate, and the date for the stocks below. I gave you NLY, which is a powerful mortgage real estate dividend pair. It pays 13.2%. The dividend rate is $1.20 and the dividend date is on July 30th, 2019. I want you to do this exercise and find those criteria for Chevron, Verizon, and AT&T. Find the dividend yield, how much percentage it pays. Find the rate, how much it's going to pay each year, and the dividend date, ex-dividend date. So please do that when you have time. Give you a little bit of practice. Now, an introduction to EDGAR'S value risk score. Okay. If you decide to take the course in Module 3, you're going to learn about my value risk score. Okay, this is a matrix that I created. It has different components. You plug and play. And it has different weights given each of those components. So for example, I'll have the market cap there, the enterprise value, beta, and other financial components. Once you get your ERS number, this will dictate your initial position size in the Slingshot swing trading method and guide you on how much initial stock to buy given your total allocated funds. Okay, the higher the risk score, the higher the ERS score, that means the more riskier that company becomes. So if Netflix has an ERS of 5, and let's say you wanted to invest $10,000 into Netflix, then you take that $10,000, you divide it by 5, you get $2,000. That means your first purchase into Netflix stock should be no more than $2,000 as a beginner. Once you get better at it, you can create your own risk parameters and go off of that. But my ERS score I developed to give you an idea how much money to risk on your first purchase. Okay, because remember, you're going to buy, and then if stock goes against you, you're going to buy more. So if you spend all your money at once, your first initial size, then you're not going to have any funds left when the stock gets cheaper, right? So I try to give you a risk score for you to use as to how much of your total money that you were allocating that one trade, how much of it should you use at the beginning. And then on the secondary, you'll decide based on what you learn in my class how much more to buy. Of course, some of it has to do with the Martingale strategy. So I'm giving you my personal 100 large cap list of stocks that you should trade as a beginner. Okay, here you go. And I'm giving you the ERS score for some of those companies. Okay, so let's say Apple is number 1, Amazon is 1, Bank of America is 4, Las Vegas Sands is 6, Starbucks is 3, Uber is 9, Tesla is 6. So if Uber is 9, you're going to take $10,000 divided by 9, and you should only use, $1,000 whatever dollars for your first initial position size. So I'm not going to give you the whole list, but I have a whole list of all the numbers in my module 2. Okay, so as a beginner, this is the companies you should trade. All of these companies here have a market cap of more than 50 billion, and best believe the financial institutions and hedge funds are going to accumulate these companies when they get cheaper. Okay, with the exception of few companies here, look, Uber is being one of them. It's below 50 billion, but for them, I'd say 99% of it is above 50 billion. Okay, so as homework, you know, what's the difference between classwork and homework? On your own downtime, when you finish this video, I want you to take this list and I want you to separate the dividend stocks from the growth stocks. And because I mentioned the importance and the differences between the two, and when you're trading these stocks, over time you'll know which one is a dividend stock, and you know you should write a little D next to the ones that are paying dividends, so you can know that, okay, this company will not recover as fast, or this company will have a strong bottom if it hits this point, and so forth. So it's always good to know which companies are growth companies and which companies are dividend paying companies. So as far as exchange traded funds, if you don't want to take risk on company specific risk and you're afraid of earnings report whipsaws or what have you, you can buy ETFs. ETFs are exchange traded funds. They work just like mutual funds, except you can trade them every day. So the way I made my money is ETF options, the most safest and most conservative way to play options. So these ETF select sector spiders that I'm giving you are my favorite ETFs to trade. For example, let's look at XLE. Okay, if you're trading XLE, is an energy ETF, and I'm giving you some of the holdings, the major holdings of XLE. The ExxonMobil right now, they hold 23. That fund is holding 23% of its fund into ExxonMobil. Then it's holding another 22% in Chevron, 5.8% in ConocoPhillips, and so forth. So if you're buying XLE, you're automatically buying all these gas stations, all these oil companies. Isn't that great? Why would you want to buy individual companies when you can buy one index and immediately gain exposure to all of those companies at once? The only advantage I can say of taking a company-specific risk is, let's say, out of all of these, let's say Chevron is the LNG leader, liquefied natural gas leader, then you might want to have more exposure in LNG leader. Then you know Chevron's going to do very well in 2020. You might want to buy Chevron separately and own XLE as well, right? Because maybe you don't want the problems associated with ConocoPhillips, so you don't want to buy XLE. So that's another reason, right? Same with XLK. Let's say XLK is the technology ETF. It has Microsoft, Apple, Visa, based on those percentage holdings. And maybe you don't like the way MasterCard management, what they stated in the last conference call. You're afraid of the risks that MasterCard has, or the changes they're going to make. You might want to not hold XLK because, even though it has most of the technology companies, it still has some exposure to finance side, which is Visa, MasterCard. So what I'm telling you is XLEs, they give you a broad diversification of many large cap companies, but it also brings you their risks with them, right? So, but ETFs are a great way to trade. ETF options and ETFs are a great way to have exposure to many companies, and you don't have those earning whipsaws, right? So, each earnings date, these companies have a very smooth and steady way of trending. So it's very easy to scale in and scale out of these companies versus have major gap downs and gap ups on individual companies based on company specific news. Okay, so now that I talked your ear off about ETFs, I'm going to show you my actual trades that I've done on my short-term portfolio and my long-term large portfolio. Okay, so there are some companies that I'm holding long-term, and I don't mind if these companies actually generate lower profits as long as they consistently generate profits. And I trade them with the same slingshot methodology that if they sell off, I'm constantly going to buy them until I recover my losses. So I'm going to show you some examples of what happened on some of the trades I made. So this one is Walmart, right? Walmart, I bought it in the beginning of 2018, right? I bought my first purchase, I bought $4,200, and then I bought it on a technical basis, but it failed, right? I bought it on technical basis, it failed, so I'm like, okay, on the financial valuation basis, I'm still okay because it's Walmart. I'll hold this company forever. So Walmart started losing, and I started losing money on it. So you know what I did? I bought more. After it sold off and all the smoke cleared, it sold off, so I bought another position size, which was almost twice as much bigger than the first position. So, and then it sold off even more, so I kept a steady, and I stopped my purchases. So even though I was doing my short-term trading on one side, on my portfolio side, I was not holding any more retailers until I saw some signs of optimism and some signs of recovery. So as you can see, here, let me point here. As you can see, when Walmart went through its consolidation, I was waiting for this slingshot to pretty much shoot me higher, and as soon as when this breakout occurred, I made another purchase, right? So my third purchase was a little bit less than the sum of the previous two purchases. So I bought another $10,000 worth of Walmart right here because I saw the breakout coming. This was a pure consolidation, and then I saw a nice resistance breakout. So this was a no-brainer with a large volume spike. So I added more Walmart, and I turned basically $1,000 loss into almost $1,000. Now, it's not a great gain because I only made 4% in almost a year, but I'm just trying to show you that over time I knew I was going to recover my losses, even though it took me almost a year. But I sold my shares over here, but I want to stress the importance of keeping your position sizes, and it doesn't have to be exactly double the previous amount, just like with the Martingale strategy, but I understand that if I double my position size as it sells off, during the recovery, I'm going to reach my break-even point sooner, okay? So let's look at the actual numbers behind it. So the first was I bought 40 shares, right? I bought $4,000. Then on March 16, I bought twice the amount of last time, so 80 shares. I put $7,000, right? And at this point, my losses were at $624. And then my losses hit its peak at $1,000, guys. That's when Walmart went down as low as $84. And then the recovery began, right? Slowly recovered, and my losses became less. And then on that breakout, remember, I bought 120 more shares. And boom, right there, I went into the break-even point, and I started seeing profits. And the way I got my 4.22% gain is I take my gain and I divide it my total cost basis. Okay, for those of you who are wondering, like, oh, you made way more than 4.22%. No, you're not calculating it right. You're supposed to take your gain and you're supposed to divide it by your overall cost basis that you've sold, you've bought. Now, the next one is Facebook. So my picture might be covering most of this chart, so I'm gonna pause this and get rid of my PIP so that you can see the whole chart. Okay, hold on one second. Okay, guys, that's fine. Let's see. I don't think it shows my picture anymore, so here we go. Okay, so the okay, so I decided to move the actual camera. I couldn't figure out how to completely get rid of the PIP while recording. But anyway, that's fine. So this is the Facebook trade. As you can see, this is a much better trade, right? So this is I made close to 12% in 3 months. So this one I used option puts, and I'm going to show you how the Facebook trade. I'm a big believer in Facebook since the IPO came out. I've been buying Facebook since it was $45. So every time Facebook had a huge sell-off, I jumped on it with full force. So I turned a $1,400 loss to almost $6,000 with the help of option puts. Okay, so again, my first purchase was 50 shares, right? And then when it gapped up, I sold. I took some nice profits, sold 35 shares. And then I made another purchase at $9,000 between mid month of May. And then when, remember, all the privacy issues and all the chaos began, I saw a couple of series of days of sell-offs hit Facebook. And when I smelled that, I smelled fear, and I realized that Facebook was going to fall through its major support of 180, I immediately bought 5 option put contracts, and I made a killing on that. So I'm going to show you the numbers of what actually happened, and hopefully my face is not blocking a lot of this chart, but you can see that. So let's go step by step. On April 22nd, I bought my 50 shares, paid almost 9 grand. And then I made a nice little bit of a profit. I realized $275, right? I sold 15 shares, and I kept the 35 shares. Okay, right here. You see that? You see on beginning of May, that's when I had 35 shares coming down on Facebook. And then at that nice little breakout, I bought another 50 shares, right? And then spent another $9,000, and at this point my unrealized losses have moved from $642 down to $148. And when that sell-off was imminent on May 31st, okay, I'm sorry, on June 3rd, that's when my losses were at its peak, right? It's $1,400 losses, but at the same time, that's when I already was selling my option puts. So even though I had a loss of $1,400, I sold my option puts at the bottom, right here. Right here. So I bought my option puts here, I sold them here, even though on my stocks, I was taking a loss. So right here on my stocks, even though on my Even though on my stocks that I was down $1,457, I already realized $3,000. So technically I was still at a positive. And then later on at that breakout, again on the recovery right here, on this recovery, after it went back up to 180, mind you, this whole time I didn't buy any shares. I just waited for my shares to recover. And right here on that breakout, I bought more. And that, to me, technically the slingshot was here, but in this scenario, at some point, sometimes I don't want to risk additional capital. So in Walmart's case, I might get in a little bit early, but in Facebook, I just didn't want to add anymore because I already was taking, I had a huge position size. So if I need the money to use it for another trade, or I need to use it for protective insurance with option puts or what have you, I don't want to risk too much of my money. So I waited it out. I didn't do anything this whole time. And then I at this point when it broke 185, I jumped in one more time. Right here. So lastly, I bought 150 shares, and that gave me that brought me to a break-even point on my stock shares. Okay, so my losses turned into gains on the stocks. I'm not calculating the options. I'm keeping, even if my options didn't exist, right? I'm just looking at the stock basically. If you had do it with the stock position, no option protection. At this point, because my position size, I increased it by 150 shares. My break-even point came much sooner, and I realized I had an unrealized gain of $412. And then on June 18, I sold 200 shares, which was majority of it. I had an unrealized gain of $706, but I realized $1,600 by selling the 200 shares. So at the end, I spent about 50 grand total of all my cost, and I had a realized gain of $5,200, and I had an unrealized gain of $700. So if you add all the gains, you divide it by my total cost basis, gave me almost 12% gain from this trade, which was about 3-4 months. So for a lot of people, this is much better than the Walmart 4% a year. But if you're managing a large portfolio, guys, a lot of people are happy with 5% a year if you can deliver it consistently. If you could do 30% a year on a very large portfolio, I'm talking about 100 million plus, if you can do 30% a year, hedge funds will steal you away. You have to understand that the larger your portfolio gets, the harder it is to deliver the same amount of gains, because it's intuitive, right? The more your portfolio gains, the more stock classes you're supposed to have, the more protection you're supposed to have. And at some point, you have to get into the fixed income market, which I'm not even going into yet. I'm just doing equities. But at some point, if my fund grows, then I'm going to tap into the fixed income market. And fixed income market is a whole different beast on its own. Okay, guys. All right, hang in there with me. I wonder how many of you actually paused this video and watched it another different day, or you're still actually watching this. I give you props, because I'm tired of talking. So, no more realized losses, guys. And if you do, it's going to be a very small percentage. In this swing trading course, my goal is for you, just like you saw in this example, is to turn your unrealized losses into gains by averaging right time, buying the right companies, buying the right companies that the hedge funds want to accumulate. And I gave you the list. I gave you everything. So even if you don't buy my course, I'm giving you so much free information. You can, use your common sense and go do this. It's very easy. So you have the list of 100 companies. You buy it incrementally. Okay. You use the Martingale strategy concept, where you increase your position size at the right pivot points with strong volume reversals, doubling, tripling down if you have to hit your break-even point much quicker when the reversal happens. Okay. Number three, you're going to learn to hedge with stocks, options, and inverse relationship industries. Like I said, oil versus transportation, gold versus SPY, multinationals like McDonald's, Yum Brands against the US dollar, right? Multinational companies have a lot of their revenue from overseas. So you can hedge them with the US dollar. So there's all these things you can do. And then number four is you use options to leverage when you run out of money. So if you're averaging down, you might be like, Edgar, I don't have $20,000 to buy if Facebook falls here. I don't have $30,000 to buy the third time Facebook falls another 5%. Well, guess what? You can take the same amount of risk using options. So you use options as leverage, but you got to learn options. Options is very complex, but it's going to open a whole new world for you. Okay? Options are called derivatives. They derive their price from a security. So if you're buying Apple options, if Apple moves $1, it derives its price from Apple. So if Apple moves $1, the option might move $60. So whatever time expiration you pick and whatever strike price you pick. So options are the biggest thing that has occurred that changed the entire stock market game. Stock market is no longer a rich man's game because you can control $50,000 worth of risk with only like $500. That's amazing. So again, you use these methods and for swing trading, not day trading. Okay? So day trading has its own set of rules, which I'm not going to talk about in here. So when you're using this slingshot swing trading strategy, the biggest question for you to ask is, how long are you willing to wait for this recovery to occur of your stock or an ETF? And number two is, do you have comparative advantage in another stock? As in, do you want to realize a loss and jump into another company that's moving? Sometimes that's better. Let's say if you have a Goldman Sachs is going through the roof and you're stuck in an energy company and oil prices are just flatlining or they're going down, there's nothing much happening, global slowdown, concerns, and the oil keeps going down, then you might be like, all right, I want to jump out of my energy company and get into the Goldman Sachs bandwagon because Goldman Sachs has momentum. They just beat earnings and it's going to run higher. So maybe once in a while it makes sense because you don't have extra money laying around on the sidelines for you to own Goldman Sachs and hold energy company, Chevron or whatever. But remember, when you have a couple of stocks, especially if they're diversified, different sectors, again, you're entering the portfolio management arena and you're not there yet. So this course is teaching you to use one stock or one ETF to get in and get out profitably, one by one. I'm not teaching you to do this with multiple companies at once, okay? Last, I want to talk about margin risk. This is the mother of all risks. When you open an account, you're going to open either a cash account or a margin account. So a margin account means you're borrowing your broker's money to amplify your gains and losses. So it's a double-edged sword. If you're borrowing money, you're going to use that money, then if a trade goes against you, you're going to be liable for that. Okay, so borrow margin conservatively. By the way, I keep looking over here because I'm also taping with my other camera, right? So you can watch both videos on YouTube. So don't think I'm going crazy. I'm looking here, I'm talking here too. So margin risk is very important because they can force liquidation on you. Your broker will email you a margin call and say you need to share this many you need to sell this many shares to bring your equity up, or you need to deposit more money. So most brokers, they'll give you an overnight 2-to-1 overnight leverage. Okay. But if you're trading, you're day trading, you have a higher leverage, usually 4-to-1, 6-to-1, depending on your account size. But the overnight leverage, if it's most of the time, it's going to be 2-to-1. Okay, so if you have $10,000 in stocks, you can hold up to $20,000 in stocks for the next day. Okay, so you need to have equity of half. If you're holding more riskier companies, smaller companies, you gravitate outside of that list I gave you, and you go and trade your risky companies, then your margin risk is higher. So your broker is going to want you to put in more equity for that. Okay. So if your stock drops in price significantly, then your broker will ask you to sell some shares to maintain that 2-to-1 margin based on the new price. Again, few tips. Margin is a double-edged sword. It amplifies your losses and your gains. So for riskier companies, your margin allowance will be even less. Okay, so again, please stick to large cap names, or even so, don't even use margin. Just if you're a beginner, then just try out cash account until you get better, and then you can use margin conservatively if you're scared. Okay. So for day traders, some brokers will allow them to borrow up to 6-to-1, but by the end of each trading day, it needs to be reduced to 2-to-1 overnight margin. So, as a day trader, there's a lot of day traders out there who play it smart. They'll reduce their position size down to like 80-90% cash at the end of each trading day. But some of them will trade, will sell everything. Will be 100% cash by EOD, end of the day. So, but a lot of them, they might want to, if they're fairly bullish on one stock, they might want to keep some positions open overnight. No problem. Just because you're a day trader doesn't mean you have to sell everything. You can sell most of it, but not everything. So yeah, that's about it. And lastly, I want to say, guys, avoid unnecessary risk in life and in stock market. Okay, this face your fear bullshit needs to stop. I'm getting, I know people die right and left because they're trying to face their fears. You're stupid. What are you doing? So in life, let's talk about some unnecessary risks. And guess what? I've taken some of these risks myself. Okay. I used to ride motorcycles in Russia when I was 12 years old, in Kazakhstan, sorry. We had a bike club, and I was riding motorcycles in a bike club in the snow, granted, but it's still a risk. I could have broken my leg, my arm, right? So in life, some unnecessary risks. Riding a motorcycle, skydiving, bungee jumping, especially with a short cord, petting a tiger at a zoo. I know Cat Williams has a skit about petting a tiger at a zoo. People get angry why the tiger bit him. Well, the tiger is being a tiger, you idiot. It's in a cage. What do you think is going to happen, right? So in stock markets, I can give you a million different things you can do as considered unnecessary risk. Okay. For example, you short sell a strong company, or you buy a long a very weak company. Okay? Right now, if GameStop is falling, you're catching a falling knife, and you keep averaging down. What if GameStop turns into Sears? Sears became a penny stock. Did you see what happened? So be careful. Catching a falling knife is number one. When you're averaged down, I'm recommending averaging down. But if you're averaging down on a loser stock, for example, like Bed Bath & Beyond or GameStop, be careful, because these retailers are, might be in the verge of bankruptcy, right? So why you throwing good money after bad, right? So I would average on a company I know has billions in the bank. I'm not averaging down on a company that's full of debt and is just barely surviving and it's burning through cash. Just use common sense. Again, there's an exemption in day trading. Day trading, you can short a strong company, you can buy long a very weak company, so that the rules are different. This is just swing trading. So another one is having 3 different stocks open that are in the same sector without hedging or being properly diversified. Okay, if you have many companies under the same sector, even Jim Cramer on Mad Money, he has the diversification skit, right? So proper diversification is very important because remember, if you're looking at your beta and you're under the same sector, under the same industry, and that one sector gets hit hard, let's say, you remember the tech bubble crash in 2000, and let's say you had nothing but tech companies, then you're going to lose the most, right? So proper diversification is very much encouraged, especially in portfolio management, right? For day traders, waking up late 10 minutes before market open instead of 30 minutes, assuming your internet will be working fine and your computer won't have to restart after the updates. You know how many different type of instances I can tell you, pure stupidities that I've done that cost me thousands of dollars? Sometimes it wasn't even my fault. We had a power outage in Texas and there was a severe thunderstorm and I lost electricity. So, I called the broker and the broker put me on hold. It took me forever to get a fill and I lost a lot of money. I didn't see that coming. I couldn't control that. So there's some risks you can't control. But if you drank the night before, you got hammered, and you're going to wake up in a major hangover. And if you're on the West Coast like I am, you're waking up at 6:29 and your brain is not fresh. And boom, your computer now forces an update or whatever. You're 1 minute late, you just lost money. As a day trader, yeah. I'm sorry, if you have positions open, but you lose an opportunity as a day trader, right? So that 1 or 2 minutes at the open is very crucial. So you might miss an opportunity, and if you have a position open, you wake up late, you might lose money. So avoid unnecessary risks. I don't have to repeat this again, guys. In life or in the markets, there's a ton of unnecessary risks. Just make sure you avoid all of them. And I want to sum this up by saying that one of the best things I loved about the stock market is I don't have to talk anymore. Okay? I've met so many stupid people in my life. Oh my God, so many. And one of the things I hated the most is debating and arguing with a stubborn and stupid person. It's just, you won't get anywhere. So what's the point of wasting time, right? In the stock market, you never have to debate or argue. You never have to do that. You just take their money. That's it. If you lost money, then that day you were the stupid one, right? So in the stock market, whoever wins is the smartest. So you don't say a word, you just make a few single trades and you're done. And you cannot point fingers, buddy boy. You cannot. This is the one thing, this is the one job where the only person you're going to be pointing fingers at is yourself when you're looking in the mirror after the market closes. If you lost money, you just look in the mirror and say, you were very stupid today. Somebody else outsmarted you. Because the markets will always have opposing opinions, and whoever's on the right side of the trade ends up being the smartest. So money sees no color or the type of education you have, nobody cares. It doesn't disappear, it just flows from one pocket to another. Okay? All right, and I want to give you a little bit of a preview on what to expect on Module 2, Module 3, and Module 4. Okay, again, it's Module 2 is very easy. It's technical analysis, it's playing video games. You know, this is the part where a lot of people enjoy. We're going to go look at different hedge fund followed crossovers like Golden Cross, Death Cross. I'm going to talk about detecting market manipulation and spotting trend reversals. We're going to get into the first step of Slingshot swing trading method, which I kind of talked about with the ERS score. Then the 3 technical analysis assumptions every trader ought to know. The momentum stocks that can't find direction. The identifying support and resistance levels, head and shoulders, inverse head and shoulders, double tops, triple bottoms, and so forth. And then we look at some oscillators that I personally like MACD, RSI, Bollinger Bands. And then I'm going to turn up the heat on you. In Module 3, you're going to learn how to do financial analysis. All the stuff I learned in my college upper classes, you know, instead of $40,000 that I paid, I'm giving it to you for $400. So you guys, you better jump on this opportunity. You're going to learn everything. Okay. First off, you're going to learn about the 2 parachute trading system, which is, I have that concept where if I get into a stock, just like the Walmart trade, if I get in and my technical analysis parachute fails, my financial parachute is going to land me through safety. So I'm always protected. We're going to talk about differences between portfolio managers versus chartists. We're going to look at the ratio and financial analysis, which is going to take up most of the module, which is we're going to dissect the company's financial statements, profitability, debt, equity, and so forth. We're going to look at the ERS score, the matrix. Now, you saw the valuation. How I got the number is looked at. We're going to look at it in the matrix. So the matrix is going to have all the components and all the adjustments, and you'll get to decide if you want to tweak those adjustments later on as you get better, and maybe reduce the scores so that you take less risk, or you'll know exactly after you see the matrix and the components. You'll know exactly. You might even take some of them out. But I'm telling you, this is what I use for my personal valuation. And then I'm going to show you how my valuation compares to the Zacks rank. You know, the Zacks website you went to, Zacks has a really good ranking score, which I like. But sometimes I don't agree with them. So we're going to look at that. And then the last module is moderate, challenging, but it's more interesting than finance part, which I love the finance part, but a lot of people love the trading and learning about options. So I'm going to give you the intro to options, the basics of the options. I'm going to give you a lot of secrets and tips of how I evaluate my option contracts before I buy them. Okay, and I'll give you a little hint right now. Basically, when you're looking at different option contracts, you can look at the day expiration, how many days left, take the option premium value, divide it into days left per expiration, and that'll give you per day cost of expiration. So you're looking at your option premium value on per day basis, and that's how you compare it to different expiration dates to see which one is more expensive and which one is cheaper. So we're going to look at different worst case scenarios, because that's what it all boils down to, is looking at worst case scenarios of every trade, right? You make a trade, what's the worst that can happen based on the beta? How far, what's the worst standard deviation has it happened historically? So which translates into how much can I lose, right? And then averaging down with options, you got to tread carefully because you got to know options. So we're going to look at the Greeks. It's not the Greeks that you think of. It's the option Greeks, delta, gamma, theta, vega, rho, and implied volatility. And we're going to dig deep into short selling. Short selling, averaging up, not down. When you're starting out, you're just averaging down when your stock falls. But when you're a short seller and your stock goes higher, don't get scared. You're averaging up. So you're lowering your cost basis, averaging up. I'm going to talk about psychology a little bit. You need to learn how to lose your ego quick. The sooner you lose your ego and bail if necessary, then the more money you'll save. So sometimes that's important also. In day trading, that's all it counts. In day trading, you're constantly losing your ego. At this point in my life, I have no ego left. I admit that I'm wrong at least 5 times a day, okay? So to me, it's normal. I can care about, predicting the future. When you're starting out, you're constantly trying to predict the future. Nobody gives a shit. Sometimes I don't even look at CNBC, right? I don't care. I care about getting the direction right, okay? So, hedge fund secrets, tips, and tricks. I know a lot of them, so I'm going to teach you a lot of little things to watch out for. And my secrets and tips are priceless. I think it's everything that I learned over the last 15 years. So there's a lot of information. And all of this is just the basic training of the bootcamp. I just cut your hair and told you to start, running miles and doing the jumps and all that, running through mud. So this is just the beginning, guys. When you get into options and hedging, it's going to be life-changing for you. So that's about it, guys. This course is officially over. If you have any questions, by the way, you're going to take tests and exams as soon as you start on module 2, 3, and 4. So get ready for that. The answers are on the last page. Please don't look at the answers if you're going to take the tests. Again, if you have any questions, email me at edgar@stocksbootcamp.com and I'll get to you as soon as I can, or you can email at support@stocksbootcamp.com and they'll get back to you as soon as they can with any issues, technical issues, and so forth. Alright guys, that's about it. Thank you so much for watching. Hopefully you enjoyed everything, and I'm not going to say good luck trading because I don't believe in luck in trading. Trading is about killing your enemy as soon as you can. And after you graduate my boot camp, you're going to be commandos. Alright guys, see you later.